everyone. Thanks for joining us for our retirement reality check. My name is Marian Ross, and I'll be your moderator this morning. I just wanted to start with some brief housekeeping and an overview of how today's session will go. I'll be asking the panelists a series of questions for maybe 30 to 40 minutes. And of course, after that, we'll open up the floor to questions from the audience. If you would like your questions to be answered, please type them in the Q&A chat. Now, today I'm joined by three very esteemed gentlemen to walk us through this topic. The first person is Derek Osborne. Derek is currently a partner and senior actuary at Telus International Health Practice in the Bahamas. He's an actuary with over 30 years of experience and has performed actuarial reviews for most of the national insurance and social security funds in the English-speaking Caribbean. He also provides a very wide range of policy, actuarial, and operational advice to social security funds, governments, and public sector entities. Joining Derek Osborne is a second Derek, who we'll call Derek Jones. He has been admitted to several bars in the Caribbean and as a solicitor in the United Kingdom. Derek is a former managing partner for Miles Fletcher and Gordon in Jamaica. He's also a former founding partner of HSM Cayman. Under Derek's tenure, both firms were, of course, ranked by the authoritative guide of Chambers and Partners. For his sins and high standards, Derek now chairs the Cable and Wireless Jamaica Pension Fund, the Red Stripe Pension Fund, and the Jamaica College Trust. Derek, thanks for joining. Last but certainly not least is Mr. Charles Ross. He is the founder and president of Sterling Asset Management. In his role as president for the past 25 years, Charles has prudently led the team and guided Sterling's investment and portfolio management functions, and of course, kept the company focused on delivering higher risk-adjusted returns to medium and long-term investors. Charles, Derek J. and Derek O., welcome. Thanks for joining us today. The goal of this conversation is to better inform and prepare investors for future stages of life. According to author Susan Wilner Golden, the learn, earn, retire adage no longer holds. People are living much longer and healthier lives, and of course are having diverse and varied experiences in the second half of life. We found this author, Susan Wilner Golden, who wrote a book called Stage Not Age. If anybody wants homework, it's quite interesting. But she makes a point that learn, earn, retire no longer holds. And she actually talks about the second half of our life in as many as 18 stages. I guess her central point is that people are living longer and healthier lives, and of course are having diverse and varied experiences in the second half of life. Ultimately, today, I believe we're addressing the reinvention and legacy stages in life. And, how do we prepare and to live competently through these stages? She calls them Renaissance, reinvention, legacy. We thought they gave a lot more context to the experiences that people go through. And we thought it was a very good perspective to think about financial preparedness from. So we also did some quick research. I won't take too long going through these, but the IMF published a report in 2024 that said that the financial stability of Eastern Caribbean defined benefit social security schemes is actually under strain. And in fact, they found that in 2035, the reserves would be depleted in Antigua if the current trajectory continued, and by 2040 in St. Kitts. And the graph on the right really shows that the share of population age 65 and plus, the black line is for the Eastern Caribbean, the population is expected to age at a much faster rate than typical developing nations. And we thought that was pretty instructive because, again, the aging population suggests that, a smaller base will be supporting a larger group. Jamaicans also face the added challenge of devaluation and even just higher inflation. I think this figure 9% is a little dated actually. It could be 11% of working Jamaicans. Only 11% of working Jamaicans are covered by approved pension plans. The Jamaican dollar itself has devalued by over 95% since 1990. And similarly, the population age 60 plus will rise from 13% in 2023 to 22% in 2050. And even if we're already saving in US dollars, there is still inflation in the US if you think about it. And if you look at $100,000 in the bank in 2025, by 2024, it will be worth 61. It will have the purchasing power of $61,404 at 2.6% inflation. So just some context for the hurdle rate that we need to consider when investing for our retirement. And this is my final slide. The good thing is that these problems are not unique to the Caribbean. The developed world is facing similar issues at a different scale. Spain, France, even in the US, there's a projection that the Social Security will be in a deficit by 2033. And of course, we see in developed countries that, you know, they're pushing up the retirement ages. They're asking younger people to make more contributions. So these are themes and principles that I guess we want to explore a little bit more and understand what they mean for us. That was really our context for setting the conversation. It's obviously a relevant and timely topic. I think what I would start by doing is maybe opening a question to the panel. And of course, I'm not trying to age anyone on the panel, but I thought that maybe each person on the panel could tell us one thing they would tell their younger selves about retirement planning. And Derek O, could we start with you?
Morning, and Marianne, and thank you very much to Sterling, and thank you very much to all the people who've joined this morning to listen to an interesting conversation. I'm sure hopefully many ideas and new ways of thinking about retirement and thinking about ensuring that we can live comfortably thereafter will come up today. So in terms of my younger self, and I think what I'll say is that I never made a formal plan or formal specific objectives in terms of, you know, I want to be here with a fund for education for my two children, or to be a certain dollar value for retirement savings. And even though I've fared pretty well, I would say, you know, you earn, you save, you invest, and then you spend. In my case, I'm a prudent spender, I would say. But, you know, it's kind of you fly by what happens, more reactionary than being proactive. And certainly I believe I probably could have been further along had I been more proactive with a firm plan. You have written objectives where here's where you want to be at, you know, at age 45 or age 55 and age 65, and work towards that. And every few years, you review where you are and see what needs to be done to get there. You know, I've talked to people who have a travel account, they have a retirement account, they have different accounts for different things that they want to do in their life. I never had those things. And so maybe the message to my younger self may have been just that, to be more deliberate and to be more forward thinking, as opposed to just reacting to what comes my way.
That's awesome. I love that, Derico. That's a great takeaway. Very thoughtful, being more deliberate, more forward thinking, having a plan, reviewing it in the future as well for adjustment, because of course the market changes. We do see that on our side where, you know, the environment changes, so your strategy and maybe how much you put aside, what you invest in actually has to change. So that's a very good point. I really like that takeaway. Thanks.
Thank you.
Charles, what about you?
I think the main message, I really agree with Derek about the planning. I myself didn't do a lot of that, but I think starting to invest earlier. You know, I was very good at saving, you know, in my 20s and so on, but I didn't really start investing until I was in my 30s. And the real issue is that you need to save, but you need to invest, because small differences in return over a long period of time make a big difference to the end value of your savings and investments. So the main thing that I would say, in addition to Derek O's very good advice, start investing early. Save, but invest. You need to invest to get that higher return, which is going to, amplify the value of your savings and investments over time.
Thanks, Charles. I appreciate that. Starting early on and small changes making a big difference to the long run. We see that a lot when we do the math, and I guess if you do a plan, you will see that. That's a good point. Derek J, tell us what your wisdom in your wisdom, what would you tell your younger self, even though you're already quite young?
Yes, I'm 77 years young. But first of all, thanks very much for having me, and welcome to all of the people across the Caribbean and indeed, the rest of the world who may be here participating in today's very interesting program. Back in the day, the advice that was given to people in a political setting was vote often and vote early. Of course, with advances in electoral protection, that's no longer possible. But it's the same advice I'd give to people about saving. Save early and save often. And without wanting to trespass on people's religious beliefs, there's a saying, if I take Charles's point, that Jesus saves, but Moses invests. Now, I would think that until I was probably about 50, I was more concerned with paying college education fees than I was with saving, because those were current costs, and there was stuff that just had to be done. And there was not a lot of cash floating around that you could say, well, let me invest in this or invest in that. Growing up in a very high inflation environment back in the 70s, 80s, 90s, deposit rates in Jamaica went as high as 55%, and lending rates went as high as 106%. Now, what that did was it encouraged people who were able to participate in inflationary assets to do so. Land, not motor cars. And so, that was a very common strategy among my peers at the time. You have to get on the inflation train. You have to buy a piece of land. You have to buy a house. I suspect it's probably pretty much the same today. And Derek's point, I think, is crucial. You need to have a plan. I think that my generation probably got away without too much planning because of inflation, but that's no longer the case. So that's the advice I would give people. You have to have a plan, and you have to try and stick to it, even though the cash flow may not always be as happy as you would like.
Derek J, thank you. We're definitely getting feedback on the Jesus saves, Moses invests line. So it was a hit. It was a very good point, and certainly real sector assets are something that have done very well for people in the long term. And it's certainly something we'll get to today. So thanks for that tidbit, guys. So moving on to some heavy lifting. Derek O, maybe let's get the actuarial stuff, the hard math out of the way first. Tell us, based on your perspective as an actuary, can contributors comfortably rely on their government or private pension plans to support them in retirement?
Thanks for that question. And so for decades, there's been an image of a three-legged stool that has been used for retirement planning. So the idea is that to be solid in retirement, you need to have a base that has at least three legs. And those three legs are Social Security or National Insurance, that's the government national pension plan, an employer-linked pension plan, whether defined benefit or defined contribution, and then personal savings, right? Children and your siblings and your village and your neighbors is not part of that stool, right? And as we all know, we are having fewer and fewer children these days, and the role of that children see in terms of taking care of their parents is different from it was 30, 40 years ago. And so none of the national insurance systems or pension plans specifically are designed to replace all of the income that one needs in retirement, right? So the idea is that you have these three different sources of income, that together should be able to provide you with adequate income that you can move smoothly from earning into retirement years. Okay. And so I know in Jamaica, for example, where the national insurance scheme there does not pay very generous benefits, that compares differently to the Eastern Caribbean, where they're quite generous. Up to 60% of one's final average wage is the target in the Caribbean, in Eastern Caribbean. Yes, it's extremely generous. And one slide you showed earlier about them having challenges in the mid 2030s, late 2030s, is because of that. You know, demographics have made the populations older. The contribution rate has not been increased as much as it has. So, for example, in Jamaica, you pay 5% contribution rate to NIS. In Barbados, it's 19.75%, right? It's pretty much 15% across the Eastern Caribbean, or will be in the next few years, the average rate in the Eastern Caribbean. So the idea is that Eastern Caribbean has generous Social Security plans. Not many people are involved, other than government workers, are enrolled in pension plans. And therefore, the burden for them is going to fall on their own personal savings, or their children, or the neighbors, or the breadfruit tree down the road, right? So it's really important that that people think about, you know, and start planning and looking at what their NIS pension might be. You know, if they're not in a pension plan at work, then they have to maybe double up their savings to offset the lack of that particular leg and that three-legged stool.
Appreciate that. That was a great overview. Thanks, Derico. I guess depending on where you are, yes, it's your personal savings, different components of that three-pronged approach would be you'd rely more heavily on. That makes a lot of sense. And I guess we will get to what to do with the personal savings, because I tend to think a lot of people on the call will also be relying heavily on the personal savings. Before we get there, Derek J., you sit on the board of a few large private pension plans. And I thought it would be interesting for you to tell us the single most important thing you would want. One, the contributors to know, and two, the investment managers to know.
In Jamaica, the Office of the Prime Minister is fondly known as OPM. The pension funds that I sit on, my fellow trustees will tell you that I talk to them all the time about OPM, but that's not the Office of the Prime Minister. That's other people's money. And what we do as trustees is look after other people's money. And the message to the contributors, we try to be sure that that message is, we will look after your money. We will do so responsibly. We will not put your money at risk, and you can depend on us not to disappear to Brazil with your money. The same is true to the people who manage the money, that our expectations are that you are going to bring professionalism to what you do, and that we are trying to protect OPM, other people's money, and we expect you to behave accordingly. If I could tell you one little thing about inflation, because it's a subject that the investment managers talk about, and how can they beat inflation to preserve the value of people's money. In 1970, and you see, inflation, it's a real thing. This is not some fancy economic concept. In 1972, I bought a 1,800 square foot, 3-bedroom house for 22,000 Jamaican dollars. I borrowed $5,000 from my father, $5,000 from my father-in-law, and $12,000 from a building society. The mortgage payment was $129 a month, which was a stubborn amount of money. But guess what? Today, that will just about buy me a patty. So when you start to talk about inflation and planning for how your money is going to stretch, it's a real thing. This is not some economic fiction being talked about in ivory towers. It's real, and it has a direct impact on what you're able to do. So that's part of the message for our contributors, that you have to be conscious that this is going to happen. And it's part of the message for our money managers, that your job is to make certain and protect me against just only being able to buy a patty.
Well said. That was very instructive, very, very instructive. And I think it also shed some light to investors that are actively investing for themselves as well, their personal savings, the questions they need to be asking themselves and their managers. I thought that was great. Thank you. And maybe, Charles, we could start with you here. What should people, and even I'm seeing a question here, somewhat related, what should people be doing to on the personal savings side of things to supplement maybe the government or NIS pension plans? What should people be doing? Where should they be looking? Maybe what questions should they be asking themselves?
First thing is that they need to have savings. So they need to put aside money for the long term, and they need to invest it. As Derek O mentioned, say in Jamaica, the public social security benefits are minuscule. They're almost irrelevant to most people. So really, there is each person carries a huge responsibility for looking after their pension and retirement income. So the first thing that you need to do is that you need to invest the money at the best risk-adjusted return that you can get. I mentioned earlier that a small difference in return can make a big difference in the long term. Just to illustrate it, if you get a 1% increase in your return, say from 3% to 4%, 4% to 5%, over 25 years, you have 50% more value. So it is worth taking the time, doing the research to make that investment that's going to give you 5 or 6 or 7%, as opposed to 2 or 3% in the bank. And the other thing, the good news is that relatively modest returns over a long period of time add up. A cousin of mine retired in his 50s, very, very comfortably. And his philosophy was, look, I need to get 7% per annum on my US dollar investments. And if I can do that, I'll be happy and I'll be sitting pretty. In the Eastern Caribbean, with the EC dollar, you don't have to worry so much about currency depreciation. But the challenge that those savers and investors face is that there are not a lot of investment assets available locally that can give them the diversification, the risk return trade-offs that they need for the medium to long term. In Jamaica, we sort of close our eyes and say, all right, US dollars, or maybe some real estate, maybe the stock market. But at the end of the day, you really do need to aim for at least a 7% per annum return on your investments over the medium to long term.
Thanks, Charles. That's certainly instructive. It also, I think, brings home another point just about the planning and the preparation, because of course, as the environments change, different risks, that 7% means different things in different environments. So coming back to Derek O's initial point about checking in on your plan from time to time, it's really quite valuable. Now, return US dollars, we spoke about US dollars as a store of value, 7%, small differences in return making a big difference in the long term. Maybe my next question would be, you touched on real estate. What would you say, maybe I guess we could take real estate from two angles, one being from the perspective of the pension funds that are managing it, maybe Derek O and Derek J. And then I'll take it from the personal perspective with you after, Charles. So maybe Derek O, can you start by telling us, you obviously have viewed what's in many different long-term investment pools of funds across the region. How has real estate, what role has real estate played as a store of value in those situations?
So real estate is a mixed bag, I would say. And a lot of my work is in the public sector. And you find that, for example, NIS schemes, when they, I use the word acquire land, it's not always at their choice, right? Oftentimes they're instructed to buy something over there from somebody who they like. and so forth, right? And so when you start off with a not so good investment, oftentimes the returns tend not to be as good as you would like. Of course, you have liquidity issues where, again, if it's not a good piece of property, then you have difficulty selling it if you do want to sell it. And then you have some institutions who go into active real estate investments, right, where they either don't have the skills to do it, right, or don't hire the right person to manage investment. So you have that challenge as well. And what I saw the other day was where it was a pension plan and they had a property, but the value was well more than what anybody would pay for it, and so 25% of it was lost on you know, 1 year over the other because they realized that the value of the investment was just not as high as it was, and so I would say it's mixed. The returns could be higher than usual deposits and bonds. But one other point is that you also have to know when to sell. A lot of people get emotionally attached to their property or emotionally attached to an investment or their baby, so to speak, that they made 20, 30, 40 years ago. We have Derek J's apartment from 40 years ago, whatever, right? But often you must know when to sell, right? Because sometimes it's better to part ways, even when it's not a good investment, right? Put the money someplace else and try to earn that 7% that's probably possible elsewhere and move on.
That was very helpful, Derek O. And you've touched on, I think, a lot of things that we have also observed. And certainly knowing that, I think the most important takeaway I take from that as well is that real estate is more complex than you would think. A lot of people think real estate is just buying, holding, putting down, collecting rent, but there are there are nuances to every investment and expertise involved in it. That's helpful to know. Derek J, I know you've given us some context already for your experience in real estate.
Yeah.
What from both perspectives, what would you say?
Well, I come from a real estate generation. And that was partly because we did not truly understand the stock market. And my generation was afraid of it, partly because there were people who put on their pajamas at night, but they don't go to sleep, right? And they're just trying to figure out how they can make money between the price of Apple when it opens in Frankfurt and when it closes in Singapore. And they're only interested in a tiny percentage because they're investing billions of dollars. For many years in Jamaica, real estate was the go-to. It was a safe place to put money. I think it's probably correct to say over the last maybe 10, 15 years, the returns on the stock market have probably done better than the returns in real estate. But the key to that is not a place for amateurs. That is a place where you have to have good professional help. And if you don't mind my saying so, some of the assistance that people like Sterling provide is crucial in that area. This is not kindergarten. The learning curve is very steep. You can lose a lot of money if you don't know what you're doing. Real estate, you buy the piece of land, you put it down. It's hard to lose money because Master God not making any more of it. And so there's a built-in improvement in the value. So the combination of things that you look at in a pension fund, if I take one of the pension funds that I chair, the average age of the employees is 41 years old. So an investment that has a horizon of 20 years doesn't scare me at all. I'm quite happy to be investing in something that's going to pay off in 20 years' time, because that is when I need to provide the pension for some of the employees. I think part of our culture has been infected by the American infatuation with what's this quarter's results. This quarter we did well, last quarter we didn't do well, therefore the world is coming apart. I think that has infected the way that we look at some of these things. You have to take a longer term view, whether it is stocks and bonds, whether it is financial instruments, or whether it is real estate. So that's what I would try and put into context for people.
Appreciate that a lot, Derek J. That was great context. Thank you. Charles, from your perspective of your experience, maybe also from what we see on our side of investors coming to us at their respective stages of life.
Well, it's very interesting because I've really not viewed real estate as an achievable investment objective because of, as Derek mentioned, the fact that interest rates in Jamaica at one stage were, 50%, and lending rates were in, triple digits. But it is, and it can be a useful part of a long-term investment portfolio, with all the caveats that both Derek's have mentioned about, the actual asset that you buy. Now, the average returns in Jamaica certainly are, in the in the mid single digits. So you're not, yes, you can get lucky, but you're not really going to hit the jackpot. But having a piece of real estate that you've paid off over your working life, you're getting some rental income that's great. However, as you age, when you get past into your 70s or 80s or 90s, do you really want to be running around chasing tenants, fixing leaking pipes, dealing with repairs after they leave? So at some point in time, the point that Derek O made is that it may be the time to sell, take in some cash, invest that cash in secure, relatively, low risk, fixed income investments that will hold their value, give you good income over the medium to long term.
Thanks, Charles. I'm glad you mentioned that because one of the questions in the chat is what kinds of investments should people in their maybe say 50s and 60s, kind of just on the cusp of the second stage of life, be considering during retirement?
The traditional thinking was that, when you get to retirement, sell your stocks, sell your real estate, buy bonds, and live happily ever after. However, people are living a lot longer now. So that I think that, yes, you want to shift the focus of the portfolio towards income. But I think you can still maintain, if you have good equity investments, if you have good real estate, you can certainly hold them, I would say, easily for the first 10 years of your retirement, 10, 15 years. If you get into your 70s or 80s, you may at that time want to shift a little more of the portfolio into bonds so that you have less hassle, more secure and steady income, and you don't have the physical running around that might be involved in maintaining real estate, and you don't have have the volatility of the equity markets.
Thanks, Charles. Appreciate that. I am getting, I think, a few questions specific to investments, but maybe I would give both, maybe I'll start with Derek O, each panelist a chance to say a few parting words. Maybe tell us the thing that you're most either irate or happy about in this industry. You could let us know, some closing, a closing position, and then I'll open up for questions. Derek O, we can start with you.
Okay. A lot of the talk so far has been about investments that most people, especially in the Eastern Caribbean, don't have access to. And we have to find a way to allow the small man, or even the one with, a good professional job and a good income, to find a way to open an account, maybe with the sterling or some of the US dollar account, that they either can manage themselves or pay somebody to manage. That's not really available. And across the Eastern Caribbean, we have some bad experience, so we had CLICO and BICO, and people have lost faith. A lot of people have lost faith in these big institutions. We also see here Sagicor making large profits. So these insurance companies making large profits that come on the back of individuals, who want to save money. So there is a concern. And so it's how can we find a way to set up whether it be multi-employer pension plans or savings plans where individuals can invest through payroll deduction in a small way, but in a cost-effective instrument, right? A lot of times, when you put money aside, 15-20% goes towards admin cost of investment. Your mattress is safer than that investment, right? So how can we find a way to allow individuals, regular, men and women, 20s, 30s, 40s, to start saving in an efficient way, exposure to the US market, exposure to a mix of assets that are going to give them a good rate of return over the long run, and that they can, first of all, keep it locked in till 65. That's the other thing in the Caribbean. We hit a jam and we go pull out our savings, and then we borrow money from our pension plan, and then when we get old, it's smaller than it should be, right? How can we find a way to opportunities for additional savings that are locked in until retirement age?
That's an excellent point, Derrico. I'm glad you brought it up, and it's certainly something we will explore, how to make these investments more accessible, because the instruments certainly exist. I think there probably is some nuance around the distribution and regulation, but certainly it's not inconceivable. I mean, from our perspective here in Jamaica, we have a very large percentage of our labor force that is not formally employed or self-employed, or a lot of people have started just, for example, using a mutual fund as their pension savings tool. They've found substitutes in the absence of a formal scheme, and they're actually slightly better off even without the tax benefit, because they're getting exposure to the global markets, they're getting attractive returns, and in fact returns that are probably higher than some of what the pooled funds pooled managed funds are yielding. But certainly there are some structures in Jamaica that I think are attractive, and we can explore how we can collaborate. Derek J, what would your kind of final thoughts or be?
I'm actually very excited about sessions like this, because it brings together people who have legitimate concerns, and it's an opportunity to share information, share points of view, and hopefully to stimulate ongoing discussion. One of the things that helps people a lot is to understand that the problems they face, everybody else pretty much has the same problems. The Lord has not sought you out for any special adversity. Your children are not going to be able to buy a house if you don't help them. The need for the younger people to have access to capital, to be schooled in investment, you probably have to start that process in the schools, quite frankly. But if you ask me what I'm excited about sessions like this, because I think that it really provides an opportunity and an impetus for people to talk about this stuff, go out and get information. In Jamaica, I know that there are a number of highly developed sources of that information, and maybe discussions like this will stimulate more of that throughout the Eastern Caribbean.
I appreciate that, Derek J. Thank you very much. I am now just looking at the chat. With the current volatility in the market, should I still be investing? Or should I still be investing in the market, or should I sell my investments and put my money in a bank account? I guess maybe Charles, you could take a stab at that first.
I'd like to say, first of all, that would be a terrible idea. One of the things about the main difference between an investment and a bank account is that the value of the investment can fluctuate from time to time. And in fact, the reason that there's a higher return on investments is really that there's higher risk. And that risk really is reflected in the volatility of the value of the investment. So there will be fluctuations in the values of stocks, bonds, even real estate to a certain extent, but in real estate, you hardly see it, because unless you go and do a valuation, you won't know. But unless, it depends on how one has invested in the stock market. For example, if you've bought an index then, if the index falls by 10 or 20%, that's not the time to pull out. In fact, that's the time to consider investing more, because it's unlikely that in 20 years' time, the US stock market is going to be lower than it is today. It's possible, but it's unlikely. Again, if you've bought certain stocks and the value, those will be even more volatile than the index. And even stocks of huge corporations, that we household names, Apple, Microsoft, Nvidia, whatever it is, those prices move up and down tremendously. The question is, what's the overall trend? And if the overall trend is up, and if we expect that trend to continue, then unless current developments are fatal, and we think that Apple is going to go out of business or, suffer some huge permanent tragedy, then we hold investments. And the reason why we try to diversify is just because of that. So we hold some stocks, we hold some bonds, we hold some real estate. Initially, maybe we're concentrated in one area or the other. As a young person, you generally tend to be more in stocks than, say, bonds. But you have to accept the fact that even mutual funds, those values will vary. And that variation is part of the intrinsic nature of those investments. And it's why you only get 2% in the bank, but you can earn 10 or 12% in the stock market. But it's not going to be 10 or 12% every year. 1 year you may be down 10%. The next year you may be up 15. In the long term, your investments will earn the return of those instruments. So certainly, in fact, doing what that question has put to us is one of the reasons why many people lose money when they start investing, because we tend to look at historical returns. The mutual fund did 10% last year, let me get in. Of course, it may do minus 5%, may do 2% this year. And we say, oh my God, this is a terrible investment, we get out. Next year, it does 20%. And then when we look at the overall rate of return, it may be 10% on average, but it's not going to be 10% every year. So bottom line is no. You look at, yes, if there's volatility, you look at the portfolio, you see, well, is there anything that's fatal? Then if there is, yes, you can get out. But otherwise, no, you stay in and you ask yourself, do I need to put more into this? What's the long-term perspective?
Appreciate that, Charles. Thank you. And I guess what you said of stocks is also true for bonds as well.
Yes, no, indeed. Any investment security will vary in price. And even real estate, as Derek O pointed out, that value can fluctuate too.
I think
Thanks,
also,
Charles.
Marian, a healthy dose of common sense is something that we need to remember. I have this cousin in Nigeria, his brother-in-law owns a gold mine. Man, we could get in early and make a lot of money. No, that's obviously a scammer,
Yes,
I'm going to put my money in the bank, I'm going to make 1%, but it's safe. That's probably not a good idea either. So, there's an old nun who said moderation in all things is important, including in moderation. Yeah. And so a healthy dose of common sense, I think, in terms of how you approach your investments. Good inquiries about the people you're doing business with, because reputation and integrity means a lot more than just the pretty advertisements. So those are the two things. Know who you're doing business with and use your common sense.
Those are such tremendous points, Derek J. The common sense and knowing who you're doing the business with. I think because in finance there is some jargon, people feel intimidated, but certainly they should feel free to push hard and ask questions, no matter how seemingly simple they are. You should be able to understand things as if it was explained to a 5-year-old, as we say. We have a question here maybe for Derek O. 2 quick questions. I live in the Eastern Caribbean earning an average salary and have no idea how much I can expect to get from the government when I retire. Does Derek O. have any kind of data, or can he share where someone can get an idea of what to expect? And you could probably also take a question, I think that was sent in by WhatsApp. What's the difference between the defined benefit and defined contribution, and how does it affect me? Yeah.
In terms of the government pension plans, I'm not sure if you're referring to government employees or the Social Security or NIS scheme. But from an NIS perspective, you can look, if you work 40 years in the Eastern Caribbean countries, you could look forward to about 55% of your final salary, or final insurable salary. If you're really high earnings, then you may earn more than the ceiling. But up to 55% of the ceiling is definitely achievable in the Eastern Caribbean as a pension for life when you retire after 40 years of contributing. If you don't know, it's best to go in. There are people there who can help you estimate what your benefit will be if you keep working until retirement, or depending on whether you stop, and so forth. And the same goes for your government pension plan if you're a government employee. In terms of why some plans are underperforming, I'll give you a true story. One country I was in the other day in the Eastern Caribbean is a fund of 8 million EC dollars invested solely in bank deposits, earning 1.5%. And that was all of the savings for that pension plan. And the reason was, I believe, individual trustees don't know much about investing, don't know much about savings and savings, and they make choices they're comfortable with, right? It's a defined contribution plan, and I'll come to that next, right? And so the members are the ones who are giving up 4 or 5% opportunity returns in other investments, but they feel safe, they sleep easy at night. But when they look at what they could have received over 20, 30 years, it's a huge difference. And so in terms of pension plans, they come in 2 types. There's the traditional defined benefit, which is pretty much, the employer is the one who bears most of the risk. There's a formula that determines how much one gets when they retire or when they quit, right? And it's based on, say, maybe 1 to 2% for each year of service times their final salary. And so the future is uncertain, and therefore the actuary helps the employer in terms of how much they have to contribute every year to keep the plan solvent. The defined contribution plan, which is now very common and what most companies are moving towards, is a plan where each person has an individual account and the contribution rate is fixed for the employer and for the employee. Let's say 5 and 5, right? So the employer's obligation is fixed at 5%. The employee gets deducted 5% from his salary. That money goes to an account, and whatever the investments earn, that's added to the investment account. So if it's 2% or 5% or 8%, your ultimate accumulation of assets or investment fund will be smaller, medium, or larger, depending on the return. So in a DC plan, defined contribution plan, the risk is borne pretty much by the employee. In a defined benefit plan, or DB, the risk is borne predominantly by the employer.
That's very helpful, thanks. And I guess it's a big incentive for people in DC plans to proactively request their statements and follow up with their investment advisor or their HR rep to figure out how their funds are performing.
Mm-hmm.
Speaking of how funds are performing, Charles, we have a question. What are the top 3, or what are the top investment types that have proven and promised to continue to provide substantive returns, especially for people with no national insurance or pension plans?
3 main investment areas or assets are stocks, equities, bonds, which are a form of loan or fixed income, and real estate. I mean, those are the 3 broad categories. Now, in developed markets, the sky is the limit in terms of investment assets and so on. But I think for most people here in the Caribbean, those would be the 3 areas that you look at. Now, as part of the equity bucket, you can have mutual funds, which are focused on equities, or mutual funds that are focused on bonds, fixed income. And you also have combinations. So you'll have a growth fund which might have, a big chunk of equities, a chunk of bonds, and some real estate. So really, those are the sort of, but the three areas that I mentioned, equities, bonds, real estate, are the sort of three core areas in the Caribbean. Equities are in countries with stock markets, in countries where investors have access to international markets. Equities are the most accessible because they really require the lowest initial investment. And there, of course, is a tremendous variety and a huge market out there in terms of options. But they also, over the long term, deliver higher returns. And so again, the idea is, especially for young people, you would want to invest, certainly have equities as part of your long-term portfolio. Global bonds, again, there's a very wide variety of global bonds with different risks, returns, duration, time to maturity, etc. And those also can be accessed certainly from Jamaica, and I imagine through local or international brokers from the Eastern Caribbean as well.
Sure, maybe to put more color, I think, to what Charles has said, Mr. Roberts, I think you asked that question. At least currently in the market, I think we see a lot of value in fixed income and mutual funds. So Sterling would say have a mutual fund that a lot of people have used as their savings for retirement, maybe for their, I think it's the most popular investment. One of the reasons, because it appeals to people at all ages. A young person saving for their retirement, they use it to supplement their pension. They may use it to save for their kids' college education, or if you're older, they may put money for the grandkids, or it could be your growth allocation in your second half of life. That fund has done about 10% per annum, which is an attractive return for the level of risk. Bonds are typically most popular. I think global bonds are popular because they're very liquid. They're easy to sell. You're usually taking, as Charles mentioned initially, it's a lot easier to map your risk and return profile in the US and European markets than it is in the region. So global bonds have been popular among people in their in their second stage or second half of life, where they're looking to replace the income they would have earned from their business or from their salaried position, or maybe from their real estate. We did a few portfolios recently for businesses and individuals that had sold real estate, and we were actually able to double the rental income in some of the cases. Of course, they would have earned capital gains on those assets. And you also are able to earn capital gains on bonds. So people that bought bonds in 2023 and 2022, for example, are up quite attractively in the price of their bonds now, because bond prices are a little higher now than they were in 2022 and 2023. So we like global bonds because they're liquid. They do provide you with capital appreciation and a steady stream of income. I think that would be particularly important for people in the second stage of life, as they may need to sell assets to do something and get that liquidity. So in terms of global bonds, I think low risk right now is anywhere from 4 to 5%. Medium risk, generally, this is kind of a loose definition. You can think of anywhere between 6 and 7.5, maybe pushing it. And maybe the higher, that's the lower end of medium. The higher end of medium, maybe 7.5 to 8.5, and after 8.5, maybe after 9, you would call that slightly higher risk. In the global market, that's where things are priced right now. That can change as well. There are some times when low risk, there was a time when low risk was 0 to 2% and medium risk was 4 to 5. So, based on the environment, the returns, I know you mentioned substantive returns, but I guess it's all relative to the type of environment that we're in. But I just gave you those numbers to give you some context for where things are at the moment.
Marian.
Yes.
I would not attempt, at least probably not more than once, to take out one of my own teeth. Yeah. But I'm quite happy to take investment decisions that are much more technical and much more far-reaching without getting the kind of advice that I should. And so the message I would like to leave with people, ask your friends who are good people to deal with. Integrity, responsibility, technical knowledge, seek the help. Don't attempt to take out your own tooth. That'll be painful in your mouth, but if you make the wrong investment decisions, I can tell you, the pain is going to be in a different part of your anatomy, and it is going to last much longer. So get the advice. This is not amateur hour. You're talking about things that have a long lasting effect on your life. And just hearing the conversation today, there's a level of technical understanding and technical expertise that has to be brought to bear. And it's part of the reason why the pension funds perhaps don't do as well as they might. The question that people are always terrified of asking themselves is, what was I thinking? Okay? And you can ask that question regardless of the result. What was I thinking when I decided to buy this horrible investment? I must have been crazy. Or what was I thinking when I decided not to buy Apple at $5 a share? I must have been crazy. The problem is that in both cases, it's after the fact. And so the best that you can do is find the people who have the best view into the crystal ball, talk to them, talk about what your objectives are, and get sensible advice from people who are competent and who have integrity and your interests at heart.
Thank you, Derek J. Appreciate that context. It's very, very relevant. And at Sterling, we value that. We do value our expertise, but we also value bringing people along the journey with us and making sure they understand the basics of the principles of the decisions. They don't need to have the technical know-how, but forums like this allow us to bridge the gap, increase the knowledge and the comfort, and that makes our job easier. So a big part of our job is helping individual and institutional investors grow their capital, preserve it, and more importantly as well, change with the market, change with the conditions as they change, reevaluate the plan to make sure we're on for the trajectory that they want to be. And that's something we've done in many different circumstances, for pension funds, for individuals. And yeah, so I think that was, I'm not seeing any additional questions. This is a last call for questions in the chat. All right, Mr. Roberts, I see you saying that you have attempted to take out your teeth more than once. So I know that would have resonated with you. And I think will Sterling invest more in alternative investment in the future to generate more alpha? That's an interesting question. I guess it depends on what you define as alternative and where. Sterling is always interested in generating, and if I'm understanding, alpha means higher returns above the market. What we have found certainly is that locally it's not possible to outperform the S&P 500 index consistently with local alternative investments. The rates of return, what I see as private credit here, is far less than private credit offers in the US, for example. So it's not a good risk-adjusted return play. Certainly, if there are investments that have double-digit returns in US dollars that exceed what you can earn on a benchmark in the global market and can adequately compensate you for both the liquidity and credit risk that you're undertaking in this region, then certainly we're always looking. We look at a lot of deals and projects as well that are shown to us. I haven't yet found one that I think going to the point that both Derek J and Derek O made, there's not a ton of expertise sometimes on an institutional basis for some of these alternative investments. I would say we have pretty high hurdle rates, and we consider both the liquidity and the credit risk. So certainly, if there are alternative investments, so I don't know if you're talking locally or globally. Certainly globally, it's something we consider. We do look at private equity and pre-IPO deals globally and locally. But I would say locally, I have not found many that would adequately compensate an investor for the risk that you'd have to undertake.
Yeah. Marian, I'd just like to add one thing, and that is that a long time ago, a very seasoned international investor said that his philosophy was to avoid losing money. And over the long term, that really is the best strategy. And what we need to remember is that modest rates of return over the long term add up. That mutual fund that you mentioned, the 10% per annum return, in 23 years, the value of a unit is almost 9 times what it was at inception. And that's just with a 10% per annum return. So basically, if you're investing for the medium to long term, you don't need to make 15 or 20% per annum every year to have a very attractive return, to have a very valuable investment portfolio at the end of that period. And certainly for the average person, I would say it's certainly better to have a 6-7% return consistently, or an average over a long period of time, than to go searching for that 15 or 20% return, which may actually result in significant loss.
Thanks, Charles. That's a good point. A good point. I do think you could up the 6 to 7 a little bit more, but I guess maybe I'm younger than you, so that's why I say that. So yes, I think that was a good question. Appreciate it, Julian. Thank you. And I like the part at the end, Charles. Slow and steady wins the race. We have some great context. Actually, we can share if you sign up for our newsletter on what those incremental difference in interest rates. We have a few graphs, I think, that are helpful in showing what that looks like. But it is tempting. It's definitely tempting to want to earn 20 or 30 in one deal. But I found it very rare that it's sustainable, or even that it's achievable. And I think a lot of pension funds here have been burnt by that, trying to go after alternative when there's not a ton of infrastructure. But yeah, a conversation to have for sure.
And there's a scary question that emerges, Marian, which is, you did what with my money? Run that past me again. Tell me again. Brooklyn Bridge. You bought a piece of the Brooklyn Bridge because you read that it was a good deal in social media. So again, there's a reality check. Can I get 15 or 20% consistently? Probably not. Should I aim now and again to take a little chance and get a 15 or 20%? Maybe that's a good idea if you can afford to lose the money. Because to take Charles's point, it's not the money that you make that's important. It's the money that you keep. You can make all the money, but if you spend it, it's gone. So again, be reasonable in what you're doing. Find sensible people to talk to and to help you with it, and try and take sensible decisions about what you are able to do.
Appreciate that, Derek J. Good point. Good points all around. So everyone, I think that's bringing us to the end of our session today. As much as we'd like to continue, I appreciate all the questions that came into the chat. Thank you. Some of them were captured by comments that had already been made. So thanks to all who attended. I'd like to extend a very special thank you to our panelists, Derek Jones, Derek Osborne, and Charles Ross. Thank you so much. A big thank you to the Caribbean Association of Banks for organizing this and helping us to get the word out. It's certainly a topical issue, and hopefully this won't be the last conversation we have on it. We really want to keep the conversation going and looking at how we can change the landscape. So thanks everyone.